This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the market insights for Wednesday, February 10th. Well, those of you who watch old American movies may remember the famous scene in The Wizard of Oz when Dorothy's dog Toto pulls back the curtain to reveal that the so-called wizard is really just an elderly man pulling levers on a machine. The wizard isn't really a whiz at all and doesn't have any special powers. Did the Japanese markets just do the same thing to the world's central banks? On January 29th, less than 2 weeks ago, the Bank of Japan shocked the markets by instituting negative interest rates. Just in case the market didn't get the point, the bank said at the time that it would be willing to take further action, quote, in terms of 3 dimensions, quantity, quality, and interest rate, unquote, if necessary. This is about as strong a policy as central banks have. The result? It only took about a week for dollar yen to lose all its gains. Dollar yen is now the lowest it's been since November of 2014. The Topix index of Japanese stocks is flirting with the lowest level since October 2014. And 10-year Japanese government bond yields have gone negative for the first time ever. The Bank of Japan's move didn't change anyone's view on inflation. On the contrary, inflation expectations only fell further after the cut in rates. Investors are barely expecting any inflation in Japan in 5 years, or indeed over the next 10 years. Inflation expectations are back to where they were before Prime Minister Abe was elected on a platform of bringing inflation back. To make matters worse, the global contagion in financials has come home to Japan in spades. Japanese banks were in fact outperforming the Japanese stock market for most of last year, but just in the last few days they've collapsed. So far this year, they're down 27%, more than twice the 11% decline in the market overall. So what is the message that the markets in Japan are sending us? 1. The Bank of Japan is not going to succeed in bringing up the inflation rate. 2. However, it's bound to try. That means it will keep buying JGBs at deeper and deeper negative yields. This may be bad for Japanese banks. They have far more money in deposits than they do in loans, so they need to park the extra money in JGBs to earn something with it. Furthermore, when Japan lowers its rates, other countries are likely to lower their rates, so there's not necessarily any benefit to having your money abroad. And finally, the Bank of Japan's efforts are not going to help Japanese companies. The question then becomes, if the markets believe that even such a shocking move is powerless, what tools do the authorities have left? The answer would seem to be none. Perhaps there's nobody behind the curtain. That seems to be the message the Japanese markets are sending. Of course, central bankers can't just throw up their hands and give up. I therefore expect to see a competition to lower interest rates deeper into negative territory, also known as a currency war. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.